Wonderful. So, ladies and gentlemen, I extend a warm Texas-sized welcome to all of you here today. What a fantastic turnout for a Monday afternoon. As always, we greatly appreciate you guys taking your time. Today, we are going to dive into our current investment opportunity, which is in the heart of Texas. It is an opportunity brimming with promise and potential. We did launch this investment opportunity a few weeks ago, so we are taking the opportunity tonight to do a live interactive FAQ webinar. Actually, looking here out of all the participants here, I see that we do have a lot of new investors, so I am going to ask Joe, our CEO, to go back to the beginning and just do a high-level overview of the investment opportunity. So not to worry, if you're not too aware of the details, you will by the end of this session today. And as always, we welcome the opportunity to engage, ask questions, drop them in the chat, drop them in the Q&A. We'll, of course, we'll make sure that Joe answers them for you on this session. So what we are going to discuss this afternoon is the compelling reasons to explore this venture with Astor Realty Capital. It's a preferred equity investment, it's attractive returns, and of course, the undeniable allure of the thriving Texas market. It's not just a state, it's a beacon for smart investors right now, and the time to seize opportunities is now. So as I said, we have some new people on this webinar tonight, so welcome. Let me take a second to introduce Astor Realty Capital. Under the leadership of Joe Berko, we have risen to the prominence as a current investor of a phenomenal $2.2 billion real estate portfolio across 12 major US markets. We have redefined the industry standard with our consistent track record, delivering exceptional returns of 21% annual returns to our investors to date. And tonight, I am proud to introduce our CEO and founder and our host, Joe Berko. Joe is going to share his wealth of knowledge and experience with us as he explores this exciting investment opportunity. Again, obviously, the most fantastic thing here is Joe is here live to answer those questions that you may have, as he always is. But, we wanted to do a group session. So Joe has been now in the United States real estate industry for over 30 years. He has built a successful career based on profitable investments, ethics, and generosity. His commitment to making a positive impact extends beyond the business realm, as he also serves on the board of several nonprofit organizations. Joe's career in commercial real estate dates back to 1995. He founded our original and sister firm, Berko and Associates, that specialized in investment sales, structured finance, and syndication. His innovative approach over the last 30 years has awarded him, many prestigious awards, including the Power Broker designation by CoStar and the title of New York Signature Broker by Globe Street. Joe was also appointed on the advisor of the New York State Real Estate Board for 9 years by 2 New York governors. So that just goes into just a very little bit as to Joe's experience in the real estate industry and, what he is always sharing with and giving opportunities to our investors. So without further ado, I will pass the floor over to Joe to dive in. As always, as I said, please use the chat options below to drop any questions that you have. We will get them answered. And of course, if there isn't something that gets answered during this session, I'll be sure to reach out to you after. So on that note, Joe, over to you.
Wonderful. Thank you very much, Laura. That's a great introduction. Very nice to see everyone here on the Zoom. Pleasure to meet you all. A lot of new faces and some familiar friends that are joining us. I'm always happy to see you. This evening, at least on the East Coast, it's an evening right now. We'll be talking about preferred equity. I'll spend a couple of moments to explain what preferred equity means. And we'll talk in details about this particular project located in an MSA of Dallas-Fort Worth. So 20 minutes from Dallas, 20 minutes from Fort Worth, in the middle of both of those amazing cities that are growing and exponentially, some of the leading economic environments in the United States. Nestles a place called Arlington. Arlington is where this project is. It's a nice garden style a 1970s vintage, 205 units, sort of like blue collar or workforce housing, if you will. And so this project represents essentially a short-term investment opportunity. It's going to generate 1% per month. We have about 20 or 19 months left to go on this project, and we'll explore it in a little bit more details. So Laura, if you will, please, the presentation on, please. Thank you. Okay. Alrighty. So, as I said, this project is a workforce housing multifamily located in Arlington, Texas. We'll take a look at a little bit at the high level. We have about 186,000 square feet rentable. Our total budget is around $34 million. This is a project that we've acquired in March of 2022. So about 18 months ago, we've acquired this project for a total of $27 million. And the idea is to place capital into the project, renovate apartments, keep on pushing rents, get better tenants, get better occupancy, increase the valuation, and place it on a position to sell for the next buyers as well. And so in March, as I mentioned, March of 22, we put a consortium of professionals together, our company, the public company that backs our operation from overseas, two other companies from Texas. One is local in Dallas itself, institutional group, and one other operator that is running the show with a lot of years of experience in doing it. We decided to go out and raise preferred equity in two tranches. So what is preferred equity? I'll take a moment. I know that many of you do know what preferred equity means, others don't, so I'll spend a couple of minutes on it. So preferred equity essentially is a sliver of equity that has a priority of return over that of the common equity, right? So if we look at a capital stack, and I'll spend more time about it in a moment or so, we'll go into why preferred equity is different and what are the terms of preferred as opposed to common and so on. In the event, we've spent, we raised about $1,250,000 for tranche one to do some of the renovations, some of the upgrades to the complex. And now we're second stage, we're looking to raise the next $2.5 million for tranche two, because we don't necessarily need all the capital sitting in our account and collecting interest. We're very happy to do it kind of like on smaller raises. So we're trying to raise around $200,000 per month for over the next several months in order to further along this project. The use of proceeds for the next $2.5 million will be to renovate 45 more apartments, replace some of the sagging balconies that we have, and cover the next 18 months of interest reserves and other reserves that are necessary to further improve this project. Where we are in this project today, we're in essentially sort of like a halfway point, midway point where we are today. We're in obviously Q4 of 2023, and we're looking to exit in 18 or 19 months in Q1 of 2025. Why do we want to skip over 2024? Essentially, we believe that the market is not ready for any investment sales right now, certainly not in the multifamily. Interest rate is still expensive. Folks are looking for discounts. We always plan to pass 2024 and look into 2025 when the market will be a lot more open for new acquisitions. And so we're tracking a lot of dry powder. There's a lot of investors' capital. They're sitting on the sidelines. Everyone's sort of like looking for great deals right now. We don't want to be in that market. We do have another year to a year and a half, I would probably say a year to stabilize the asset. In other words, turn all the older non-renovated units into what we're getting today and improve the valuation of the asset. So we need that period of time in order to make sure that it happens. Let's take a moment, look at the budget. And so we've capitalized the deal with about 60% of senior debt, preferred equity and common equity. If you look at the numbers on the left side, the outstanding senior loan, the first position debt is 60%, 20,857,000 is our first position. Our preferred equity combined, the collective, will be 3,750,000. Our common equity is $9.8 million. Now, in order of priority, and why preferred equity is considered safer than, let's say, common equity, in order of priority, when we'll sell the asset in 2025, the first to get paid, as always, is the bank, right? So 20.1 or 20,857,000 will be what the bank will collect. Second one to get paid will be the preferred equity. This is why they're called preferred, because they have a priority over the common equity. And then the last one to get paid will be the common equity. The common equity essentially here is $9.8 million. This is capital that was infused into the project. And that is what we call the equity cushion, right? So how much equity cushion does the preferred equity has in order to offset any sort of mitigation of any sort of risk, right? You can see also the sources and uses, how the money is being spent throughout the lifespan of the project. Of course, for those who are interested, we'll send you the presentation and this recording, and we're able to answer any questions you have. What are we looking for in terms of stabilized pro forma? What are we essentially working towards? So it's worth mentioning that when we acquired the asset in March of 22, our average rent was less than $1 per square foot. So if you had 1,000 square feet apartment, less than $1, we were making about less than $1,000 per month. That represents that $1 per square foot. Meanwhile, the market around us of comparable areas were doing much, much better. And so we were sort of like improving the asset itself. What sort of things we've done? We've opened the pool that was closed for about 4 years before we entered. So that was a renovation of the pool, taking out, the water out and, improving the area around it, making it a lot more accessible, changing the entire tiles around it, and kind of like creating it the focal point of this little community of several hundred individuals that live there. We started creating barbecues and all sorts of holidays and gifts for the kids going back to school. We certainly created a sense of community. We've had a number of bad elements that have lingered in the project from the years of primarily the pandemic and so on. And so, we've moved through kind of like changing those tenants, evicting some of them, and so on and so forth. And in the process, fixing a lot of the issues that the apartments had, the buildings had, and kind of like improving the overall face of the community, creating paintings and creating a lot more, the laundry rooms and things like that. Everything is a lot more accessible and a lot more pleasant to be. The end result is we started moving our rents and started collecting a lot more rent and started getting a lot higher rents. We now moved to about a 50% higher rent than once we initially got the project, and we still have a way to go. And I'm saying we still have a way to go because our comparable properties, we always track other comparable properties, same vintage, same years, same sort of like similar amenities in our location to see how well they're doing. We still have a way to go because we're seeing that there's still more growth in similar properties. And so at this point, I think we're kind of like, conservatively looking at $1.55 on average. And that will be achieved within a year from today, although a lot of these units are being achieved and these numbers now are getting close to it. Some of them are surpassing it, actually. We still have a way to go. We're talking about 205 units. And so, the renovation of all those units are happening on a daily basis as we speak. Our projection is to reach $3,470,000 annual income. We also collect what's called as RUBS, that is all sort of pass-through for utilities. If you have a dog or all sorts of different services that are being offered, including parking. Taking out some vacancy of about 8%, we're looking for effective gross income at around 3.6 million. Our operating expenses, which is also a conversation in itself, we believe will stabilize at around $1,770,000, giving us a stabilized net operating income and NOI of about $1,941,000. According to our calculation, $1,980,000 forward NOI, because we always look 1 year out, right? NOI sale is always 1 year out. So if we say, for an example, if we had a net operating income of, call it $2 million in December 31st, and we're selling the property, we're looking for 1 year out. So we'll be 1 year out, the potential growth for that year, trending to $1,980,000 at an exit cap rate of 5.25%. Right now, we know 5.25% is not an easy number to achieve, but we believe that in 2025, numbers will be back to about how the numbers used to be in 2018 and 2019. That environment was around a 5.25% cap rate, 5.5%, 5%. Started getting very, very tight right after the pandemic around 2021. But we believe the 5.25% is a good and attainable number. We're expecting to sell the asset for 37.7. After sales expenses and everything else, gross proceeds will be 11.5 million. 37.7, however, from our conversation standpoint, gives us enough to pay off the mortgage. If you remember, $21 million, just shy of $21 million, enough to pay back the preferred of 3.75%, and enough to give back the money to our investors on their common equity. Okay. Excuse me 1 second. Not right now. I'm a little bit so. Okay, give me a few minutes. Okay, thanks. All right, so a little bit of a breakdown of the unit and the unit counts. This will be upgraded. We actually are able to achieve higher rent. We're doing a rent analysis, and we're constantly checking to see how the market is. As I mentioned earlier, we'll take a look at how we're achieving those numbers. These are the comparable properties. We have 6 properties here that we're sort of like tracking information to see how well they're doing. The one on the left is our subject property, the Junction. And all the ones to the right are sort of like similar vintage 1970s. Some of them are 1980s. Not everyone has the same amenities. Not everyone has a clubhouse. Not everyone has a pool. The project that is the closest one over here is the lowest comp, is an inferior project. And still, we can see that on dollars per square foot, they're doing better than us. So it gives us the indication that there's room to push. There's room to push on rents. The demand is certainly there. If you look at the bottom, we're sort of like, giving the comparable average. So our subject property, if you pay attention to the bottom, our 1 bedrooms are $1.55. The average comps are $1.73, right? So again, it represents an extra $100 to $150. It makes a difference when you have hundreds of units. And then the same thing goes for the 2-bedroom. We have a way to go. So we're now pushing rents. We're seeing the occupancy rise. We're seeing the interest. Essentially, think about what's going on. Dallas and Fort Worth become super expensive markets, very, very expensive markets. And so, those who don't have the capacity to maintain the sort of rents that we've seen in Dallas and Fort Worth are sort of like being pushed down to the Class B. The Class B are also now very expensive. The demand is super strong. So all the workforce are being pushed down to the Class C, which is what it is. The 1970s, very modest type of accommodation, however, nice and clean and respectable. And so the idea is the more we see push down from the Class A to the B to the C, we want to capture that audience, and we want to give them a nice product, a much better product than some of our competition, or at least similar to the best of our competition. And so that's really where we're paying a lot of attention to. We are able to reach those rents that we're reaching right now, but we're now looking to do a little bit of upgrades, a little bit better upgrades to the units, and I think we can see it over here. I'm not going to go through this, but if that's of interest, again, you have rent projections, sort of like our verbal analysis of why we think we can achieve higher rents, and of course, higher rents represents a higher income. A higher income, basically, we're getting a higher valuation of the asset as well. Again, let's take a look at the location, the Junction, right? The Junction is in Arlington. If you look at this connecting line between Fort Worth and Dallas, there's this corridor called I-30, just I-40. It's a 40-minute drive between Dallas and Fort Worth two very, very large major employment centers. Imagine if you're a two household income, and the mom might be working on Fort Worth, the dad might be working on Dallas, the kids stay and go to school in Arlington. Each one has about a 20-minute drive. This is kind of like a perfect fit for families that are looking for serious reduction in the rents. Dallas is too expensive. Fort Worth became very expensive. So here we go. We have a perfect spot, and that's why we like it very much. There's a lot here to be said about Arlington itself and Dallas. Again, one of the strongest markets, in the top markets in the United States. Great growth, tons of growth potential. We always track, sort of like new employment trends. We're seeing lots of corporate 500 companies that are coming in. We're seeing a lot of demand, tremendous growth, and all of that translate essentially into more demand for housing. What's also unique about Dallas Fort Worth is its affordability. So it's not just kind of like a New York City or Los Angeles where you have to make like tons of money in order to be able to live in those locations. You essentially can live there and have a really respectable life and not have to pay a pint of blood every month. And so it's very, very attractive. We track a lot of information. All this information is shared with you. Employment sector, we always pay attention to the growth of employment, but we also want to stay away from what we call one-horse towns, areas where there's a large concentration around one industry. For example, Silicon Valley, might be a great market, but the concentration around one industry is not something that we feel comfortable. So we always look for areas where there's significant number of industries, so no one area can ever get significantly hurt, and that usually gives us a lot of level of comfort. More statistics, more information. I'll skip you all the gory details. You can go through it yourself. It's actually good readings. Let's talk about the partnerships and who's sort of like running the show here. American Ventures is the partners that we've taken on this project. They have many years of experience buying, acquiring, renovating, and improving properties just as this. This is their portfolio, 17 different assets, or 18 different assets that they've acquired and exited. Some of them are actually in Fort Worth, in Arlington market, and ultimately everything they do is in Texas. So they are kind of like the operating partner on this venture. We are very much involved. I'm personally very much involved in this project. Dealing with the management company. This is a management company that we've onboarded, dealing with the day-to-day folks that are running the show, the leasing people and everything else. Our entire team is very much hands-on, very much involved in everything that's going on. A little bit more about the rest of the partners. We have Premier Leaders as asset manager. Astor, that's us, of course. Evolution is another institutional group that's invested together with us. They have experience also with the operating partner. And of course, American Venture. A little bit about us. So Astor Realty Capital, like Laura mentioned, we have quite an extensive experience, investing and creating, putting investments throughout the United States. We have around 3.6 million square feet of prime real estate in major markets. We mainly track top 25 markets across the United States. We invest in about 12 of those markets. We're in 7 states. Our portfolio mark-to-market, stabilized mark-to-market, is around $2.27 billion as of this moment. And myself, as Laura mentioned, I'm less than 30 years, a little bit less than 30 years, 28 years in the market, started in 1995. Started as an advisor for public companies, private companies, was an advisor for the state of New York, all for real estate matters for many years. Around 2015, I decided to morph the company from an advisory side to actually private equity side. We have teamed up quickly with a public company that has invested capital in all the projects that we have allocated. And we have always created a portion, a sliver, anywhere from 20% or so that is allocated to what we call our friends and family. So what's the deal with friends and family? Essentially, the Friends and Family Club is the why we moved away from the advisory to private equity. In 2014, I've decided that the market is shifting. I haven't seen the value add in the world of brokerage and advisory. I felt that, you know, the market is really going through some sort of a shift, and really what the market needs is equity, and what investors such as yourselves are looking for is for somebody that will be on their side of the equation, as opposed to essentially the traditional raise where you would have a sponsor developer would come in and ask for investors to show up with capital to their project, and will, you know, give you whatever terms everybody get. We decided that we have the experience, we, the company as a collective, have the experience to sift through hundreds and hundreds of projects. We go about 800 projects a year. We clear the vast majority of them as a non-fit, and then we focus on around 10 to 12 projects a year, which we deploy capital. And the way we do it is, instead of coming in, as if you, the small investor, would be coming in with a check of, let's say, $100,000 into, you know, maybe an $80 million project, right? You'll get whatever terms you'll get. We do a collection, a syndicate, right? We create a syndicate of investors, and we show up with a larger check. What does it do for us? Collective bargaining. We're able to negotiate much better terms. So the typical raise, you know, if a single investor will enter the deal, he's probably going to get, I don't know, maybe a 50-50 split with the developer, a 60-40 split, all sorts of, you know, waterfall splits that will be like that. With us, it typically is crunched to around an 80-20. We want our developing partners to make money, but we want to make sure that it's fair. I see the presentation is gone, Laura.
Yep, you're still here, Joe. I just wanted to make you the focus for a second.
Okay. And so we just want to make sure that the structure is fair. And so with this structure, we have major control over the project, where we allow our developing partners to run the day-to-day. We manage the month-to-month. And so the projects that we entered, we typically come in as the major investor. We have the public company that's backing, and then we have about 300 high net worth individuals that invest with us pretty consistently in our projects. We've trained and taught our investors not to put large chunks of money into one project, but rather diversify. Okay, diversify, create a beautiful portfolio. And that's essentially the story of Astor. We allow small investors, or retail investors, if you will, to participate in institutional size projects. And we do it in such a way that benefits them. We provide this tremendous service to check and verify and do the asset management work during the lifespan of the project. If there's any issues, we have the legal right to step into the shoes of the developer, to remove him, to replace him, to finish the project ourselves. We have professionals in our team to do the asset management. And so the end result is absolute benefit to the investor. Yes, we take a portion of the profits from the investors, but even after our portion, a part of our syndicate will make better returns than an investor that comes in on its own. And for that, we've been called all sorts of names, such as disruptors in the industry, which we're very proud of, and so on. And so that's, in a nutshell, the story of Astor.
Wonderful, Joe. Thank you so much. I do want to take this opportunity to get a couple of questions in front of you. And as I've said a few times, guys, take this opportunity to speak with Joe. He's here to answer your questions, no matter how little or how big they are. He is here for you guys. So I have a couple here from Rowan. Rowan, I believe that majority of them have been answered. So please let me know if you want Joe to dive into any of them a little bit deeper. But Joe, can you just spend a little bit more time explaining the returns, how we have partial paid current, and then the rest accruing at the end? If you can just go into that.
Absolutely. Absolutely. So the way the preferred equity works, when tranche one, the interest is 12%. It's 1% a month. and we pay it quarterly. We've had some requests to pay it monthly, which we're happy to oblige, but we pay it quarterly. And so every month that you stay with us, you get 1%. Some of it is current, other part is accrued. And so let's focus on going forward on tranche 2, which is where we're heading into in our discussion. Tranche 2, all the investors from the beginning and everyone starting January 1st are going to generate 14%. So that's a little bit, obviously, more than 1% a month. The way we do it is we'll give you 10% current, again, paid quarterly, on your investment. So for example, if you invested $100,000 on a 10% current, obviously you'll get 2.5% of your return on your investment on a quarterly basis for a total of 10%. And at the exit, we'll give you a catch up of an additional 4% per annum. So that's how we do it. If you started earlier with us, we had groups that started with us on tranche 1. That they started year 1, it's 12%, and that was 8% current and 4% at the exit. Everyone is moving into a 14% starting tranche 2. The initial part, the initial group, and the tranche 2 group as well. I hope that answers your question.
Wonderful, wonderful. Thank you, Joe. And now we do have a question in regards to the tax document that gets issued. I will actually be answering that one. This one will be a 1099. It will not be a K1. It will be a 1099, as we are paying interest on this deal. So a tax document that you get every year come tax time, because you are receiving cash on a quarterly basis, you'll receive a 1099, not a K1. When it comes to tax time, of course, our optimal goal is to issue tax documents within a prompt period before the tax deadline of April. Very, very common in the real estate industry that there are sometimes delays. With this current sponsor, we actually didn't experience delays last year, so we do anticipate being able to issue that tax document by the April tax deadline. And again, that is a 1099, not a K1. And as of right now, Joe, that is it. Is there anything else that we can please drop in the chat, ask in the Q&A? Of course, Joe and myself are available after the webinar for any questions that that may come to mind. But is there anything else we can address whilst we do have Joe live here with us tonight?
Well, I'm very happy to see you all in the Zoom. And of course, any questions, if you want to have a private conversation with me or with Laura, if you have more questions that you don't want to ask in a public manner, please feel free to reach out.
I do have one here, Joe. I apologize to interrupt. Can you go into the timeline a little bit more in relation to how long is this raise going to be open for? When do we expect investors' commitments, and when do we expect them to fund?
Wonderful. So essentially our timeline, as I mentioned, is until end of Q1 of 2025. And so every month that we go, we're going to be we're looking to raise a similar amount, roughly about $150,000 to $200,000, to keep on capitalizing the program that we have, doing more of the renovations, having enough of the reserves necessary in order to keep this project moving forward. I don't have an interest at this time to raise the full amount one shot, because money will be sitting in our account, deploying very little of it every month, yet generating a very high amount of interest. And so we've been doing this for tranche 1. We're looking for around about $1.5 million and $2 billion a quarter so far in tranche 1. And then now we're starting to count for tranche number 2. So if you're interested and you want to enter now, that's fine. If you want to enter in November, that's okay. December, it's okay. We're looking for small tranches, and that's what we're doing it. This is open to non-accredited investors, which is important to mention. Minimum investment is $25,000. And so there's no rush on our end for the raise. We're going to be doing it a Zoom once every couple of weeks in order to keep on raising. So we kind of like have an even keel as we go forward. That's in terms of timeline. But again, the exit is Q1 of 25. So if you're looking to enter now, you'll make a little bit more interest. If you're looking to enter, let's say in November, December, or January, interest will get a little bit shorter because the period of time that you'll stay in the deal will be shortened.
That's right. Now, Mike, what do you mean interested in a unit? Are investors assigned to a unit based on their investment? Joe, dive into our minimum investment and how we structure that, if you don't mind.
So minimum investment is $25,000. Individuals can invest in multiple units. We typically have our seasoned investors usually invest in multiple units. Our newer investors tend to be a little bit more kind of like one step at a time. You know, we simply do a calculation. So it's easy for me to give an example of $100,000. So in a $100,000 investment, you know, it's 10% per annum, right? So $10,000. We pay quarterly, so $2,500 per quarter. Every 3 months, you'll get a check of $2,500. Again, we've had requests in the past, typically on larger checks, but we've had requests to make that distribution monthly. At the exit, at the end of the project, there's going to be a 4% per annum catch-up. So if you're been collecting 10% per year, at the very catch-up, if you stayed around with us for, let's say, 18 months, you're going to get an additional 4% per year, or 6% on top of the 10%. That will represent a total of 14% for you, the investor. That is net of all fees. We're foregoing onboarding fees, we're foregoing all the other fees. This is paid by the project itself. And so that's, you know, it's as simple as it gets. You know, the return is always a reflection of the amount of risk. The level of risk here is very minimal, very, very low. This is not a ground up. This is an existing project. This is a project that is kind of like on a turnaround, where, you know, over $210,000 collection as of September. You know, when we started with the project, collection was $97,000. We're now at 210. We're now moving along and making renovations and kind of like increasing the valuation of the project and increasing everything. So, you know, there's no, you know, we have a loan in place. We have you know, all the elements are in place. We have a really decent management company. We're involved very heavily. And so above all, you also have about almost a $10 million equity cushion. If you remember the numbers, we're expecting to sell the asset at around $37 million, give or take. So we have just shy of $21 million of a mortgage in place. After payment of the mortgage, the first one to get paid are you, the investors, with preferred equity position, right? And so, you know, if we're selling for $37 million, you know, we'll need to hit around 24.5 million, give or take, you know, in order to pay off the preferred equity position. And only after the common equity will get paid. So you're cushioned by nearly $10 million of common equity position all along. That represents a very safe position. You know, the market, as we spoke about, is strong, and that's essentially it.
So on that note, talking about the market and our projected exit of Q1 2025, can you go into if market conditions in Q1 2025 are not where we want them to be, how go into that a little bit more, excuse me.
Sure, absolutely. So what is the conversation and what is the bet that we're taking? Interest rate is obviously a reflection of essentially of inflation, right? We're looking at inflation that has peaked in June of 2022, 9.1%. That effectively had a very negative impact on interest rate and everything else that we're doing. We knew that we need to go through a period of time before things will stabilize. Right now, if you borrow capital cost, you know, 7%, 7.25%, 7.5%, is not the environment to sell. However, we're now seeing that interest rate has been declining quite sharply from a 9.1% at the peak to, call it, you know, after, you know, maybe 14, 15 months, it's now down to 3.5, 3.6. It's hovering down. And the absolute inflation month over month, which what we've seen was a 0.1% inflation overall. considering all those things, the Feds will likely to start reducing rates sometime the next 4, 5, 6 months from now. That will place us into Q1 of 2024. Once we'll start seeing that, the markets will start accelerating acquisitions and compressing also cap rates. So we're betting that throughout 2024, certainly the second quarter of 24, certainly the third quarter of 2024, interest rates will start dropping down. That will allow us two possibilities. Sell the asset at a more favorable cap rates, because if borrowing will go back down to, call it 5.5% or so, which is where we're projecting things to be, then we'll be able to sell the asset at the 5 cap rate scenario. If there's going to be ever an event that we feel that is still not the right time and we'll need more additional time, then what we'll do is we're going to refinance our existing loan. At this point, I mean, even today we can refinance it at 5.75 to a 6%. But in a year and a half from now, the asset is going to be stable, interest rate will get lower, but the asset itself will generate a lot more income, right? Just in the last 4 months alone, we've made a revolution in the asset itself in terms of occupancy, in terms of rents pushed and all this good stuff. And so I'm looking into 2025. If in the event that interest rate or the environment is still not favorable to sell it for the amount that we're looking to sell, what we'll do is we'll refinance our existing loan. The loan right now, it's a bridge loan, so it's a short-term loan anyway. We'll refinance it, cash out about $25 million or so, pay off the existing loan, pay off the preferred investors, and hover probably the next 2 years or 1 year until we find a favorable scenario where we can sell the asset and make money for our common equity folks. So there's always a plan B. There's we don't go with one plan. But again, remember, this is a cash flowing asset. Nobody's building Class C anymore. There's a tremendous demand, certainly in that market. And so, we look very favorably about exiting in early 2025. And if we certainly have to, then we'll cash out everyone by keeping the asset through doing a refinance. So instead of paying off $21 million and the pref equity, we'll simply take a loan at around $24-25 million and exit the preferred equity that way.
Wonderful. Joe, staying on that note about current market cycles and market conditions, knowing that we have a lot of new investors here tonight, I know over the course of your career, you have gone through 3 different market cycles. Can you tell our investors a little bit about, what you've seen to date and just where, we get those projections from and why you feel so confident in them using your current experience over the years as a little bit of a branch?
Absolutely. So, I can rely back on my experience, which been around for, again, 28 years. I went through 5, this is now my 6th cycle, I believe. And every cycle is very similar and yet also very, very different. Cycles tends to be somewhere in the vicinity of about 1.5 to 2 years to 2.5 years. In some cases, like in the 2007, 2008 cycle, it was a little bit longer. It took around 3 years. That was once in a 100-year event. But everything tends to be kind of like very different and very similar. So what are we looking at? The peak of the market was actually March of 2022. The peak of the market, where interest rate was still very favorable, was what are we talking about? 18 plus months ago, so about 1.5 years ago. And so interest rates started climbing, valuation of assets started coming down. In fact, from peak to trough, and we are at the bottom right now, okay? We are absolutely at the bottom right now. From peak to trough, we're looking at an overall drop of somewhere in the vicinity of around 20%. If you look at different sectors and if you look at different towns, you'll see different conversations. But I'm talking about across the United States, there's a drop of about 20% to all asset classes. If you're in Dallas, Texas, you don't feel it, right? If you're in Des Moines, Iowa, you might feel it more. If you're in Chicago, you feel it a lot. If you're in Los Angeles, even more so. If you're in a different sector, the drops are much, much bigger, right? Let's take a look, for example, in one sector, the office sector. If you're in an office building in San Francisco right now, valuation is probably down 60 to 80%. If you're in New York City, valuations down anywhere from 50 to 60%, in some cases even worse. Chicago, same. Boston, similar. So the asset class itself makes a difference, and there's a colossal that's going on right now in that particular asset class. The second thing is, what's the story with multifamily? So multifamily essentially is very, very resilient. It has always been very resilient for obvious reasons. It doesn't matter what's going on. People need a place to stay. And quite frankly, the worse it is out there, the better it is for the working workforce housing and so on. And so the less safety is out there, the more families will move into Class C workforce housing and so on. And so in terms of where we are in the market, we've been sitting on the sidelines for about 15 months, waiting for the market condition to shift. Sometime around May of 2022, we've said stop to all conversations. We're not going into any new deals. We've had a couple of commitments, which we fulfilled, but then we said stop. And so we wanted to see the market drop. We wanted to see how interest rate will affect, and rising inflation affecting interest rate will affect a drop in the valuations. And it took a little while. It took us 14, 15 months for us to feel that the market is now actually incorporating all the changes that has occurred. And so we are now back. We're at the bottom of this kind of like, I wouldn't call it a recession because all the elements don't show a recession, but we are at the bottom of the drop, right? Now, looking forward, we are seeing that there's still a good amount of wave of loans that are maturing in 2024. A smaller amount is maturing in 2025. A lot of loans matured in 2023. There's been a good amount of pain right now. And those that have not taken what we have, which is insurance to keep interest rate low, are certainly feeling in a lot of pain. But again, what is a lot? And what are we talking about in terms of numbers? The numbers are not colossal. We're not talking about tremendous numbers. I know that there are also sensational articles out there, and just don't buy into it. Essentially, the banking system is in a fairly strong state. The exposure that banks have, even for office, which is kind of like the most sensational conversation, even for office, the amounts are very, very small in comparison to what we're talking about. If you look at all the banking system, okay, and ask yourself the question, how much of the entire US banking system is now exposure to office building? We're talking about 3% of their entire portfolio. And out of that 3%, it doesn't mean that every office building that you know of is going to default. So the numbers are much smaller, but the sensations are large, right? When a large company brings back the keys to the lenders and stuff like that. But certainly office is its own segment. On the multifamily space, we're expecting some default. But again, there's going to be a lot of resiliency around certain markets, one of the top markets, Florida, South Florida, Texas, areas like that. We're seeing, a lot of resiliency and a lot of demand. It's always a question of demand and supply. And as I said earlier, nobody's building Class C. Everything that you build right now is going to be brand new, be very expensive. And so the demand for Class C, for affordable housing, is only going to get stronger. And so, where we are in the market cycle, 18 months have passed since the market started dropping from the peak, March of 2022. And we're looking into 2024. We want to pass this period of time. There's about $87 billion of multifamily loans that are coming due that's going to get rolled over, rolled over. There will be some default in 2024, more so than 2023. There will be a lot of kind of like reshuffling and recapitalization. There's a lot of money that's available for multifamily and a lot of demand. We don't feel that that's the right time to sell any asset. We want to skate through 2024 and, like we say, survive and thrive in 2025 when the market gets better. The Feds will have no choice. There's already enough charts that show an equilibrium is being missed between the Fed rate and inflation. Okay, so the Feds will have to sort of like monitor what's happening. They'll have to wait for 6 months to make sure that the drop in inflation is not a temporary drop. It's a serious and consistent drop. And so at that period of time, we've started the 6 months period where the Fed is watching, because inflation is now very low, effective inflation, right? Effective inflation. I'm not talking about the overall inflation. Effective inflation is low. We now started a quiet 6 months period. Feds will have to drop interest rate. Otherwise, the economy will go into a deflation, which is a whole different situation, a period of lack of growth and so on. Labor doesn't allow us to go into a recession. Labor is very strong, and the numbers are very, very strong. Labor is, unemployment is like 3.8%. And so the labor market is very, very strong. Of course, the one thing that fluctuates all the time is energy. And so the eyes are on energy, and that's kind of like the wild child over here. But overall, I think that we're looking into sort of like, let's finish with the federal election in late 2024. And so that's when we're looking to position the asset for a sale at that point in time. As I said, every plan that we create always have a plan B, and the plan B, if that for any reason we're not happy with whatever numbers we get when we're looking to sell the asset, we're simply going to refinance and stay for another year, possibly 2 more years, but not with preferred equity that's kicking interest at 14%. I assure you that.
Wonderful, Joe. Thank you so much. Very, very helpful. I know I personally value your insight during these uncertain times. So very, very helpful. Thank you so much.
Very nice of you to say that.
You're welcome. So wonderful. As we are approaching the hour mark, I will drop again to anybody who is interested in proceeding forward with this investment. You have my contact information, which has been dropped into the chat. All of you here will have my email or your ambassador's email to reach out to us to either continue discussion with Joe, or if you are ready to commit, I will have the paperwork and send it over your way for electronic execution on our investor portal.
Just wanted to say one more thing. I see a question from Rowan, so I just wanted to address that. We've had 2 requests over the last 7 years plus of investors who wanted to exit early. For a variety of reasons. There's nothing to do with the project. In each and every one of those cases, we were able to reach out to the same consortium of investors from the very same group and say, hey, we have a check of a certain amount. One case it was around $30,000. The other check was, I think, even less. 2 different individuals, 2 different investment projects. And so we were able to reach out to investors on the group and say, hey, one of the investors wants out. Anybody's interested in acquiring more units? In both cases, the answer was very, very quickly yes. And then we allow the investors to negotiate, or sometimes we help to negotiate. We don't take any fees. We're happy to do it. It's a good service. Things happen sometimes in the world. You commit to something, life happens, and you need an earlier exit. So we're happy to help and accommodate. How does it normally work? You're probably going to take a little bit less, take a little bit of a discount so that the next investor feels that he made a good deal, and you're able to repatriate your invested capital earlier than the end of the project. So if ever such a situation should occur, you can always come back to us, and we'll help accommodate by putting you together with an investor or a couple of investors that might be looking to buy your position and keep on with the project.
Wonderful. Thank you, Joe. So before Joe says final words, I do want to let everybody know that on Thursday, this coming Thursday, October 19th, Joe and our wonderful COO, Marika, will be hosting another webinar on the Passive Investor's Guide to Choosing the Right Real Estate Project and Sponsor to Lead Your Investment Capital. So Joe has an entire wealth of knowledge to share with us. He is doing the Zoom on Thursday, 5:30 p.m. Eastern. He will dive into a lot more of the aspects here today. So I would love to invite you to join that. The webinar link to join will be shared by email over the next couple of days. You'll get plenty of emails from me, so no worries there about missing it. And as always, I am here to answer any questions. You have my email, you have my cell. Anything you need, I'm available, as is Joe. We are here for you guys to make the right decision about an investment with Astor or any other potential investment company you may be considering.
Very great. Thank you very much, everyone, for joining. I appreciate it, and hopefully see you soon as among of our investors in this project or others as well. Take care, everyone.
Thank you all. Have a wonderful evening.